Welcome to this year's Capital and Financial Markets Development panel. My name is Alex Pivovarsky, and I'm the head of the EBRD's Capital and Financial Markets Development team. I am asked to remind all of you that the translation in English and Russian is available on your headphones and on our interactive app if you're watching online. You can see details on the screen. We also hope to be able to take a couple of questions during this panel, time permitting. You can submit your questions on slido.com, using the code shown here on the screen, or on the back of your seats if you are in the audience. And now back to our event, which will be focusing on the subject of mobilizing private capital via financial markets in Central Asia. Like in many of our countries of operations, the countries of Central Asia are facing the fundamental challenge of opening up and growing their financial markets while ensuring resilience and stability of their economies, resilience to global pressures. This challenge of balancing between markets' growth and stability is particularly stark in the current geopolitical and macroeconomic environment with rising inflation and interest rates. At the EBRD, we have been focusing on helping develop financial markets, in particular in local currency, for many years, and especially since the great financial crisis of 2008. In this panel discussion, we would like to take stock of our joint efforts to date and take a peek into the future. Before we begin, let me explain the structure of our panel and also mention a couple of logistical issues. Our panel will have two parts. First, we will discuss the policy challenges related to local currency markets development, and we'll bring together representatives of the central banks of Georgia, Kazakhstan, and our host country, Uzbekistan. The second half of the panel will include several representatives of other important stakeholders for the market development, including local and international commercial players, our partner institution TCX, which is mobilizing local currency offshore, as well as a key donor to supporting local markets development, the European Commission. Before we begin the first part of the panel, though, I would like to give the floor to Axel van Nederven, who has been critical to developing the EBRD's and broader international approaches to local currency markets development after the 2008 crisis and launch of EBRD's initiative for local currency and capital markets development, also known to many as LC2. As EBRD's treasurer, Axel has a unique perspective of both operating in various currencies, but also reflecting on challenges facing the local markets. Over time, we learned a number of lessons, and Axel is the best person in the bank to tell us more about them. Axel, the floor is yours.
Okay, thank you. This is going to be a little bit ad-lib, but nevertheless, I want to talk about effectively two elements. First of all, why do we care? As well as why have we chosen, let's call it the approach that we've chosen in order to help develop the financial system. And the second part is how, basically, what is it that we do at the EBRD, and particularly EBRD Treasury, with regards to actually helping fostering the development of what we call the functioning of the local banking system. Now, on the why, the important bit is basically in all of our countries of operation, the banking system is effectively 90 to 95% of the financial system. And certainly in my personal belief, in developing, let's say, in developing the market space, if you can mobilize your local banks to actually be able to manage their balance sheets better, then you actually have a very powerful player in the market that can actually help basically get you through the period of the next 15 years before your local investor base is ready. So starting with that is actually incredibly important. Now, the other point that in a sense, we all need to understand, basically, most of the central banks in our countries of operation, of course, are relatively young. Yeah, they're not like the, well, probably...
It's a young one.
No, I say the ECB is younger, let's put it that way. So therefore, there is a difference between that, but nevertheless. Therefore, they, of course, had to go to a point, and particularly, and this is where the local currency element comes in, basically to getting to the point that actually the local currency is the accepted means of not just payment, but also of saving. Yeah. And therefore de-dollarization and finding the way to basically to get things to anchor is incredibly important. Anchoring normally can happen through two choices. It's either through the exchange rate regime or the interest rate regime. We certainly believe that basically the flexibility given by actually focusing or being able to focus on internal price stability, therefore inflation targeting, is the right way of trying to approach things. Hence, basically in our interventions, we focus a lot on helping basically, that's called what we call stage one. Therefore, how can you get the central bank to actually work and understand what is the appropriate level of the local interest rate? And then the second element then of course it happens basically how do you get to actually transmit that local, basically central bank target rate into the real economy, and for that you still need to use the banking system. Therefore we have developed, let's say, diagnostic frameworks in order to try to see how we can actually, how you can understand what is working, what isn't working, what is you need to tweak in order to make sure that basically the central bank has got the ability to actually get the market rate level in local currency to where it is it should be given what it is they want to do. Then the second bit we work on is basically getting the banking systems themselves to better understand how do they actually, how can they mobilize and actually utilize what is there available in terms of a local currency, let's call it deposit base, and actually use it for real economy lending. One thing that basically for, let's call it non-locals, it's sometimes very hard to understand, but one of the problems in, let's call it in a currency that is relatively new, is, let's call it, the trust by the local population might not necessarily be that high. Therefore, what we've seen in a lot of countries that the level of dollarization can move relatively quickly and fiercely. Therefore, getting to a point that you actually, therefore getting the point for banks to be able to manage, therefore that deposit flow, in and outflow in local currency, is actually one of the key things we're sort of trying to achieve. The second thing, of course, once you have the base rate, then you need to work on how do you create effectively a yield curve. For that, therefore, we're focusing very strongly on, let's say, we certainly feel that the derivatives market is the means to do it, because without the ability to manage, let's say, your balance sheet risk through derivatives, you have no means as a financial system to actually basically be proper, safe and sound. And I'll give a quick detour into the US. If you look what happened in the US in the regional banking sector, it literally is what I would describe a mismanagement of balance sheets by banks who effectively didn't understand the amount of interest rate risk that was actually embedded in the balance sheet and how that actually could translate ultimately into a bank run. It has nothing to do with liquidity policies. This is purely an unwillingness by an institution to actually manage their, let's say, the interest rate exposure that's embedded in the balance sheets properly. Hence, therefore, we really do think there's a very important element of getting the derivatives market sort of off the ground. So from a policy perspective, one of the things we always try to do is therefore help in the legal reform to make sure that close-out netting works. Once close-out netting works, at least then we have a chance to do, let's call it, to build the next steps. In parallel, what we work on is the creation of benchmarks. One of the things we learned ourselves from, let's say, the LIBOR reform is that actually, let's say, the big conundrum in a developing market always was, I have no liquidity in term money, how can I create LIBOR? And the answer is, you don't need to try anymore, because effectively through the overnight risk-free rate framework, you can actually now create a liquid and a tradable benchmark that actually is the true reflection as to where base money is. And on the back of that, then you can start to build the derivatives market. So this is a little bit the why we care. How we do things, as I said, basically, we focus on a number of issues. And I'll end with the last bit there. Basically, one is there for monetary policy reform, doing either macroeconomic modeling, communication. We do diagnostic frameworks in order to try to see sort of what are the elements that are actually bottlenecks within the local system. And then actually it's a core part of our, let's call it our delivery, is we work through what we call money market working groups, where we effectively, together with the central bank and the main banks in the financial system on a regular basis, almost go through a process of keep on working on how can we basically make the system perform better. Benchmark reform is a core element of that. Derivatives law reform is a core element of that. And then capacity building becomes actually incredibly important to get people to understand, therefore, how things work. Now, the other how is actually also very important, that one of the key reasons for the EBRD that we're operating is that we want to be able to lend in local currency to our clients. Because a lot of our clients and a lot of the countries here have enacted regulations which basically say unhedged borrowers can't borrow in anything but local currency, which certainly for us, we applaud it, we totally support it. Therefore, we want to be able to lend in local currency. In order to get there, we do the development work, but also very importantly, in order to help with the development work and our own understanding of the market, we operate locally, we transact with local banks, we have local currency liquidity pools, and we effectively take, let's call it, on-balance sheet risk in order to, what we call, bridge some of the gaps that exist within the market infrastructure. And therefore, as an IFI, we think we can take the risk, we should take the risk, because we're there to actually provide the right level of lending to our clients. But therefore, as you heard, let's say, Alex, the key bit is, the central banks are our biggest and most important partner in order to help actually the financial system to work. And really our focus is through helping the banks get there, because that's the quickest way to get a system up to a level where it actually can start to function for the real economy. I'll leave it there.
Axel, thank you very much for this introduction. So as we heard from Axel, local banks, and in particular, or especially central banks, are at the forefront of money markets development and can use various tools depending on level of development to advance. And we have been working very hard to support this work. Today in this panel we have colleagues from three central banks. From Georgia we have Deputy Governor, now Acting Governor, Archil Mestverishvili. We have from Kazakhstan, Kazakhstan is represented by Director of Monetary Policy Operations, Nurjan Tursunxanov. And from Uzbekistan, we have Deputy Governor Behzod Hamraev. And so we hope they will tell us more about how they've achieved progress in recent years. I would like to start with Archil, in part because National Bank of Georgia and you personally have been involved for a long time in the market's development. You are a long-standing partner of EBRD, working closely with us on developing Georgia's local currency market, but also, I would say in recent years, even more advanced stages of capital market. And we think of Georgia as a country that punches above its weight in a way. For a smaller economy, it's doing a lot in financial markets development. So your national bank has done a lot, and there's quite a lot of progress. So we wanted to hear from you about key steps, looking back in time. What do you think were the key elements and reforms that you've taken that help you advance? And maybe what lessons countries that are maybe a bit less advanced could take out from this, maybe what maybe you would have done a bit differently, and how these reforms, have they helped you today in the current volatile macroeconomic global environment? Have you observed any impact so far?
Thank you, Alex. So to start with the same narrative as Axel mentioned, so why we care? So our job is, of course, price stability, but also supporting long-term economic growth. To do that, we want banks to be able to lend long-term and to do it in local currency. So rather than financing short-term consumption-related activities, to be able to issue long-term business or mortgages, business loan or mortgages. So while banks are borrowing short-term and lending long-term, they have two major risks to manage. One is the liquidity risk, another one is the interest rate risk. And it's our job as central bankers to support commercial banks with the instruments so they can do it effectively, they can do it local currency. Otherwise, if they not, they will finance long-term development with foreign currency lending, and which weakens our transmission channel. So what we have done, so we started with diagnostic framework, I think it was 2010. This was the first time when we met Axel. And since that, by that time, there was no interbank market, there was no government security, virtually no government securities market developed. So banks had to manage liquidity in local currencies themselves, and because of that, they were keeping excess liquidity, and excess liquidity in general is a burden for the bank and is a cost for the total economy. So we started by taking care of legislation because you need clarity from the by regulatory, but also by the legal point of view. Also very important to have enough settlement or trading infrastructure, because if there is a risk during the settlement or during the transaction, then there will be no operation. So, and for that we are using for trading. For trading we are using Bloomberg platform, which find it very useful, like for small markets, which are integrated to our payment system and to our securities depository system, and the transactions are risk-free and it's automatic. To do repo, it takes just a few minutes from agreeing on price to settlement. So it's very important. But also very important monetary policy framework, which Axel mentioned, that central banks should be able to provide liquidity or withdraw liquidity freely and based on the demand. So when we are talking that we need to have long-term yield curve, it's very important that we start from the short term, because unless you have liquidity on the short term, there will be no long-term liquidity. So on the short term, central bank role is vital. So we need to, as I said, we need to supply and withdraw liquidity and to target short-term interest rate stability, not the quantity of the money supply. So this is a significant change when we are coming from monetary targeting. It takes policy change and also mindset from the central bank and also from the politicians. So while doing that, of course, you need instruments, you need the government securities. So banks need some high-quality liquid assets to manage that. So when we started, there was not enough government securities, and EBRD was first IFI who issued local currency bond, which has similar characteristics as government securities. So it's added to the eligible liquidity portfolio, and then other IFIs followed it. I think that is very, very important as well. So on interest rate derivatives market, so we started by allowing or promoting banks to issue floating rate loans, which was linked to the policy rate. Initially, once there was a more credibility to the policy rate and with the floating rate, then the next step is that we, under this money market working group, we developed market-based indices, which has some credibility already. It took a few years. And now we will see the second half of the year banks starting to offer long-term loans linked to market-based indices. And there will be also significant move forward. So next, our objective will be FX and interest rate derivatives market. There, of course, we had, again, identified weaknesses of our system, and one is that banks do not have enough capacity to manage their open positions, and for that they need some IT infrastructure themselves. So we gathered like 8 banks, and 8 banks will buy one IT system, and they will share that. So one of the problem of our country is that we are a small market. So, and similar to large markets, you need the same fixed investment. So it's very difficult to encourage banks to have this such large fixed investment when they don't see benefit, and the benefits will come in few years later. For we are very much focused on the efficiency of their investments and also capacity building. So the capacity building on central bank side and capacity building on bank side. But maybe the main lessons learned for us is that you need to work with IFIs. Every IFI has its niche, but for capital market development, which is like a long-term policy, and it's a long-term job. I think the EBRD is the best suited, and I will encourage my colleagues and others to work with EBRD to start with assessment and step by step to work towards development. It's a long-term process. I think we, as you said, we achieved a lot, but lots needs to be done for coming years.
Archil, thank you very much. You mentioned, of course, the role of transaction cost is important in market development, fixed investments, and of course we've been working hard, including with support by donors, to address some of these challenges. For example, we in our team in recent months had a program with the European donors to help reduce the issuance costs for smaller companies. And it was a remarkable success where quite a few companies applied to have first ever issue, and they ended up issuing a variety of products depending on company, and really attracted also IFIs and others into the market. So we will continue, of course, supporting you on this path. But next I would like to turn to Nurjan Tursunhanov, Director of Monetary Policy Operations in Kazakhstan Central Bank. Nurjan started his career in private sector and was instrumental in establishing the National Investment Corporation, which is a subsidiary of the National Bank. And Nurjan, the NBK has done a lot to enhance domestic financial stability and also deepen local currency market. As we were preparing, we also were talking about quite advanced topics you are looking at. For example, central bank digital currency, the digitalization of your financial sector is actually very high. Mm-hmm. And so tell us about the work you've done so far on monetary policy, enhancing resilience of the market. How do you see future also? Where do you see the future challenges?
Thank you, Alex. Well, we've been in inflation targeting for the last 8 years, actually, whereby in theory the exchange rate is the outcome and the main is the inflation. But in developing market and the world we were here is people tend not to look at inflation more, but look at the FX rate. FX rate is very important to population, to everyone. And after sort of 8 years of hard work, very recently, starting from last year, I think this is what I'll be really proud of, is the local FX market. We've learned our lessons and, a bit of sharing experience, seeing that I think the road to the inflation targeting is the full transparency. At least this is the lesson we learned. I think the most challenging part was obviously, as to everyone here, last year when the geopolitics in February came out. This is the point, we did intervene, and what we did it openly. We've communicated with the population and via media. We allowed two-side volatility. The effects was very volatile. We had 20% up and down. Everyone was angry, politicians were angry, not everyone is happy. But we as a central bank always, promote that, fixed rate or managed floating rate is a dead end. Eventually everyone is expecting devaluation and nobody is actually believing in local currency. I think this is a point where we did reach the point. So far we have maximum transparency. We report any sort of intervention or any operation that we do as a central bank to the local market. And one of the outcomes eventually what I have is that a few months ago we had a verbal intervention that worked instantly. So I didn't have to spend money, it only was the threat of central bank of intervening. I think this is where I can say that when you have two-side volatility, you have exchange rate in equilibrium, you can promote and you can work on developing financial market and the bond market. We have a target of entering the JP Morgan Global Index. This is where we're looking to attract international investors. First question when they come, they ask is, how about the exchange rate? Okay, we enter, how do we exit? And the fixed market is something, to say that you can be sure that at any time with sort of reasonable size according to the daily liquidity, you can actually exit the market. So the next step for us is developing the secondary bond market, which is sort of still we're struggling, we're working on that. And the roadmap for that is we're developing the primary brokers. So we're sort of narrowing number of commercial banks that can be brokers for the government bonds. So we're working on that instrument, hoping to launch it by the end of the year. So 5 to 6 banks going to be an underwriters with a sort of with liability of sort of buying the bond and developing the secondary market. So for the international investor, FX market, and then second one, how about the liquidity on the secondary market? So we're trying to fix both. I would like to, a few points mention the team of EBRD. I really admire their efforts. We also, as a central bank, we're the asset manager for the pension fund. So far, we have invested $1.4 billion into EBRD local currency denominated bonds within the country. And EBRD is sort of attracting financing locally, developing, bringing new, say, technologies or bringing new ideas, something like issuing CPI-linked bonds. They were first one. They were first one of issuing floating rate loans called TONIA. So they are pioneers on every step, which is really good, which is sort of they're bringing new ideas to the local market. And the things we work so far with EBRD is the interest rate swaps. We need the involvement of the commercial banks, yeah? And I think this is sort of a big job that we have so far. And I would like, taking this opportunity, thank the EBRD team for taking those steps, making a hard work, and looking sort of for developing, especially the local markets. Thank you.
Nushat, thank you very much. Thank you very much for all of the praise, but actually I think that the praise should go to you and your other colleagues here, because you've done a lot in the last 10 years. And as Artil mentioned, I actually, in my old roles many years ago as an economist, we were starting from these baby steps. It seemed like this process will never happen, because it seemed like a mountain. But actually now we see many countries, including you, are advancing these reforms. And from what I can hear in your interventions, actually, where you are not directly addressing the question of how you weathered this volatility, but actually all the things you've done, from what you're saying, actually helped you to weather the volatility. The flexibility built in, the transparency, the market expectations, you helped build it, and it's helping you now in this kind of turbulent environment. Now I would like to move to our host country representative, Behzod Hamrayev, who has served as Deputy Governor of the Central Bank of Uzbekistan since 2020. And Behzod started his career at the Ministry of Economy, actually looking at monetary policy also, the topic very much connected to today's work on local currency. And even in the Central Bank, you spent a lot of time working on monetary policy issues. In recent years, the CBU, the Central Bank, has been proactively working on improving your policy framework and increasing monetary policy transmission. So tell us about what you are doing and what is your way forward, how you see the future.
Thank you, Alex. First of all, let me thank to EBRD providing this kind of very good panel discussion. I am highly appreciate my colleague's point of view about importance of developing local currency and capital market issues, because it's very important for the monetary policy transmission issues. We are one of the new, youngest country who shift the inflation targeting regime. We started inflation targeting early 2020, and we tried to adjusting our monetary policy framework, its operations, instruments in line with inflation targeting regime. But if we started 2020, from 2017 up to 2024 years, we have done some kind of preparation period. First of all, one of the reform about FX liberalization, it was very huge impact to the inflation targeting. Then in the beginning stage, 2020, we started first of all set up basic things like monetary policy instruments and such kind of simple instrument, repo, swap, overnight in deposit auctions, others. Then we, together with EBRD and IMF, we developed our forecasting capacity in the central bank. Liquidity forecasting, it's very important to do providing any operation in the market. Then we introduced money market platform, to give chance banks to do trade in single infrastructure. So last year we with EBRD team creating a money market working group to aim to teach trainer or commercial bank treasurers, not only training, also get some feedback from market participants. I think this was a very good step. We see some kind of very good increasing. For example, unsecured money market volume increased, reach around, if a dollar term, $13 billion in 2022, it's 70% of GDP. And 4 months this year, it volume around $10 billion equivalent. It's very good performance. And together with EBRD, we launched, started to publish Usonia, like a benchmark and index Usonia and daily Usonia interest rate. So I think it's also very helpful for commercial banks. Minister of Finance started to issue a government bond on December, end of 2018. As a central bank, we also started to issue CBU notes early 2020. Right now, the outstanding volume of government bonds, Minister of Finance bonds, around 2% of GDP, and CBU notes around 1.5% of GDP. Last year, Minister of Finance, by the Minister of Finance, launched like a primary dealership framework, and 9 banks selected as a primary dealer in the market. So during past 4 months, we see very good performance. If you get the number, secured secondary repo market volume, it was around $5 million equivalent last year, but during this 4 months of currently, it reached $650 million, almost 13 times growth here. But there are a lot of job we should do. First of all, we're working together, Minister of Economy and Finance, to develop of infrastructure for non-residents. Last year, we, by the government, allowed to non-resident and individuals to buy government bonds, but infrastructure not yet ready. So we're working very closely with Minister of Economy. I think we hope we will finish end of this year. Also, we are thinking about, as my colleagues mentioned, interest rate derivatives, because most of the commercial banks in Uzbekistan, they provided operations use it fixed interest rate. But right now, time is good, but they accumulating such kind of risk. So against this risk, we are thinking together with the EBRD team to develop interest rate derivatives. Also, some of legislative issues, for example, local repo agreement, we are working under this project. Also, we're thinking how continue developing of our own in-house platform for repo operations, because my colleagues Archil said about a few minutes it takes providing of repo operations. But in our case, we checked last week, it was around 15-20 minutes. It's huge cost for transition cost for banks. So we should think about this issue very, very deeply. So a lot of job we could do in the future. I hope our colleagues will support EBRD and others. And because government of Uzbekistan have very huge target. Up to 2030, the GDP per capita should reach at least 4,000. It means 2 times should increase. It means capacity of financial system also should increase at least 2 times. So that's why we need a lot of local sources, a lot of foreign sources, the financing of economy. Let me stop here and welcome investors and our partners, because to Uzbek banking system, we are open as a central bank for that regulation and providing our operations. I think we could reach together our targets. Thank
Thank you so much, Behzod. I would only mention also that there's a lot of work happening both on the central bank front, but also other regulatory work. There's a big law being prepared on financial sector. We call it Omnibus Act, which could also resolve some legal challenges still in derivatives market legislation and for issuance of IFIs, covered bonds. It could help, if successfully approved, it over time could help you focus on these more advanced topics. But in the meantime, wishing you all the best as you advance. And I think I will have to wrap up this first panel because we're actually slightly overrunning already, believe it or not. So I would like to thank the panelists from the first panel. And then while they get off stage, we're going to show you a short video summarizing or reflecting on the work we're doing from colleagues from around the bank. And meanwhile, we would invite our second panel to prepare to come on stage. Thank you very much.
At EBRD, we are passionate about developing an approach allowing to offer affordable and flexible local currency financing to our borrowers. To do so, we truly believe that the best approach is to combine transactions and market development work, as both reinforce each other. We endeavor to develop liquidity pools which require to participate in domestic markets, thereby helping market development of new instruments and liquidity, as well as identify what technical assistance is most needed. Having skin in the game also makes us more credible when offering technical assistance to help develop markets, often starting with work on improving the interest rate transmission channel, focusing on monetary policy, money markets and derivatives. These are key foundations to market development.
EBRD's SME local currency program was launched in 2011 with great support from donors such as Japan, Switzerland, United States, and EBRD's own shareholder special fund. Donors provide crucial first loss that enables EBRD to lend at competitive margins in local currencies. However, to benefit from the program, the countries need to commit to reforms and policy dialogue. To date, 14 countries signed up for such commitment. These include Albania, Armenia, Azerbaijan, Egypt, Georgia, Kyrgyz Republic, Moldova, Mongolia, Morocco, Tajikistan, Tunisia, Serbia, Ukraine, and Uzbekistan. These countries have received equivalent of $1 billion in 400 facilities under the local currency program.
Since the times of Silk Road, Central Asia has always been in the center of economic and trade activities of the region and the world. The modern companies operating in Uzbekistan, Tajikistan, and Kyrgyzstan are currently thinking about expanding their operations and becoming more important player of the regional economy. And in order to do so, they need money. Foreign currency funding has always been available to local businesses, but it comes with foreign currency risk, an extra risk to handle. On the contrary, local currency provides much reliable alternative to fund business growth. And that's why EBRD launched its local currency program to support local businesses through partner financial institutions by providing them with reliable local currency funding. Only since 2017, more than 50 loans were provided to partner financial institutions, which were on lend to few hundreds of local businesses in Uzbekistan, Tajikistan, and Kyrgyzstan. That funding provided them with peace of mind and helped them to expand and grow their operations.
As part of the EBRD's efforts to increase local currency financing and develop local capital markets, the Capital and Financial Markets Development Team represents the policy arm of the initiative. We work closely with Treasury and banking teams to improve the wider financial environment of our country's operation, and to do this we articulate our reforms and technical cooperation projects around 4 key pillars. 1. Upgrading capital markets policy frameworks. 2. Enhancing the legal and regulatory environment. 3. Improving the capital market infrastructure. And 4. Expanding the product range and the investor base. Over the past years in Central Asia, our work has focused heavily on laying the foundations for market development by addressing issues in the legal and regulatory environments. This includes, for example, the derivatives reform and introduction of close-out mechanism in Kazakhstan, or the ongoing assistance that we are providing towards the new capital markets law in Uzbekistan.
I hope you enjoyed the video. Welcome to the second panel. It brings together Ravshan Kadyrov, treasurer of Asaka Bank, an important commercial partner in Uzbekistan, Ruud Brewer, CEO of TCX, a unique financial sector institution established in 2007 to help scale up availability of local currency for SMEs and other borrowers by using synthetic hedging instruments. Katarina Maternova, who is in the somewhere around, and I think she will be joining shortly. She's Deputy Director General of the Directorate General in the European Commission, responsible for operations in the EU's neighborhood. And last but not least, Jason Zulo, a Director responsible for operations in this region at Citibank. Let me turn to Ravshan first. Asaka Bank is one of the largest commercial banks. You're number 4 by assets among 33. It is state-owned, but we're working together with you on the privatization efforts for several years now. And you have personally worked for more than 15 years in various areas of banking industry, both domestic and international. So you heard the policy colleagues who work at the central banks, including Deputy Governor of the Uzbek Central Bank, working on reforms and reflecting on challenges ahead. What are the priorities from your point of view as an actor in local currency market? What reforms are critical from your perspective to focus on in the future? Tell us.
Yeah, thank you, Alex. I think it's important to reflect that in general, development of local capital markets has always been a priority on the transition agenda of any developing country.
We can't hear you.
And
can you hear? No. Can the audience hear? Is the microphone not working?
Yeah. Hello?
You could be
Mic
a little
check?
louder. Speak a little louder.
Yeah, I think it is important to mention that the development of local capital market has always been a priority for any developing country because it does provide a reliable source of funding and obviously contributes to building a financially resilient system and sustainable growth. And I think the word that I'm looking for here is holistic. And the reason I say that is because in a sense, where we're at right now at the stage of developing local capital market is important to approach it holistically. Whereby the local capital market regulators, it's important for them to coordinate their efforts with local market participants, central bank, Ministry of Finance, international institutions, global institutional investors, thereby achieving a sustainable growth of the capital market in general, which would then in turn obviously assist in reducing the foreign currency lending on part of commercial banks, which then enable slow but steady de-dollarization of the economy in general. That would obviously open up a way to effectively manage the foreign currency risk and obviously make it easier for the central bank to tame the inflation in general and prevent the further devaluation of the local currency. And I think in this sense, I would like to probably more focus in terms of the coordination of Ministry of Finance and Central Bank, because in order for the Central Bank to run a discretionary monetary policy, it is important, I believe, and I speak this as one of the largest state banks, is what we see is due to the specific nature that all of the developing countries usually go through. And this is, by the way, a known phenomena, right? Whereby the developing country is trying to achieve a faster rate of growth of GDP at the expense of creating a lot of FX risk on their balance sheet of their state treasury and overall in the general economy. So that's why I think it's important for Uzbekistan to really consider the point where while we're going through this specific stage, we need to consider that there is a lot of subsidized and direct funding that goes through Ministry of Finance. And if you think about it, it's sort of an indirect injection of liquidity. So that's why, and these are sizable amounts. If you consider that there are 10 large state banks, and all of them account for more than 80% of the assets of the banking industry in general, overall, the balance sheet and the loan portfolio on average is dollarized 50 to 60%. So you can obviously translate it into dollarization of the general economy. So that's why I think it's very important that at this stage it's coordination, accounting for the factors that 6 of those 10 largest state banks, including us, are up for privatization, which is a good thing, right? And this stage by stage, implementation of discretionary monetary policy taking effect in these specific reasons. Because if tomorrow, for instance, EBRD were to become an investor at Osaka Bank and IFC were to become an investor at a different state bank, obviously they're going to try to mobilize the private capital. They're going to try to create commercial incentive. They're going to try to finance the private sector, right? So I think it's important that the state would coordinate the efforts of, for instance, upcoming IPOs and privatization of the state-owned enterprises, which get most of the funding from the state in order to, contribute to the GDP growth. So I think overall, all these factors just come together, and coordination and holistic approach is important. Besides that, I would like to touch upon a couple of technical issues, for instance, and this is something that has been already worked on by EBRD LC2 initiative, by the Money Market Working Group, which is developing a robust benchmark rate. Obviously, this is a key and focal point in terms of creating a benchmark rate, which would then help to structure the government bonds yield. Obviously, important point was also mentioned that there are different exchanges that are in play, and they're all independent from each other. For instance, we have foreign currency exchange, we have stock exchange, we have commodity exchange, we have bank-to-bank market separately, and then we have Ministry of Finance auction system. So, I mean, sooner or later, we're going to have to come to one system and merge them all together, because otherwise, the alternative would be, just like the colleague from the Georgia mentioned, is to enable Bloomberg or Reuters international platforms to perform the OTC trades for the banks and have them, perform that function. So I think, in general, I would like to just conclude, I guess, that as we can see, there are a lot of effort needs to be done in order to build a sustainable capital market. So that's why I would like to probably invite all of the participants of the panel today, and maybe even challenge them to even more actively participate in building the sustainable capital market.
Thank you so much, Ravshan. So here, a topic of infrastructure, coordination, monetary and fiscal, role of Ministry of Finance also in helping with market development, and of course, in the future, role of variety of stakeholders with the support, in a way, through the banks, helping advance the market. Ruda, I'm not going to repeat the introduction, since I already mentioned TCX. You're working on mobilizing, creating local currency offshore. And I guess the question is, tell us more about the impact you're having, and also what is your ultimate success? So what is the view of success? As I mentioned to you earlier, we at EBRD view success is when a country doesn't need us. Do you see at the end of the tunnel, there's some countries where you could say, okay, they now have deep enough local market, they can go forward, and what does it take?
Okay, thank you, happy to do so. I hope you can hear me. So I think as an offshore provider, I always like to start by explaining that even from our perspective, the development of local capital markets is superior to actually developing access to local markets by foreign institutions. Ultimately, you want to have local currency from local capital markets. However, there is a reason why institutions like EBRD and all the other multilaterals exist, and that is simply because too often the local demand by far is larger than the local supply of investment capital. Now, the problem there is actually that there's this design flaw in the setup of the multilateral development banks. Ever since the first loan of the World Bank to France to reconstruct their economy in 1947, it actually went wrong. It was a dollar loan to a government that earned French francs. Looking back, the effective interest rate that France paid over this first ever development finance loan was about 35%, because the French franc tanked against the dollar because it was a weak economy. This problem is exactly what still is happening today. And therefore, we need to actually realize access to the international capital markets also in local currency. So that's actually one of the reasons why TCX was set up by the multilaterals, EBRD as one of the founding fathers, and supported by 5 European governments and supported at scale by the European Commission. So going back to your question, so what is success? Then I'd like to use the example of Uzbekistan. So for the last 3 years, the Uzbek som has been one of the top 3 exposures in our book. And that created scarcity. And scarcity is a good thing because it pushes you to become creative. So more and more we try to look for alternative solutions to grow and increase our product offering to Uzbekistan, but actually historically also Kyrgyz Republic, also Georgia. And there's 2 ways for an institution. You either increase your capital so you can do more, but capital increases are limited for an institution. The other option is to decrease your risk in the books. Now then, actually, we started asking our AAA-rated investors, including EBRD, to start issuing offshore Kyrgyz som bonds, or Georgian lari, or Uzbek som. In the case of Uzbekistan, we helped structuring and placing 15 of these bonds that were actually AAA credit risk combined with the full market risk of Uzbek's currency. And by doing that 10, 15, 20, 25 times, you could see in the international capital markets, hey, this is an interesting new asset. So I get full exposure to the market risk of Uzbekistan or any of the other local countries. And we learned there was a lot of demand for it, specifically combined with the AAA credit risk. But over time, when these investors kind of got used to the market risk, they thought, yes, but I'm losing some of my potential premium due to this AAA credit risk, so let's start looking onshore. This is also why Georgia, for example, can use the international capital markets first by the sovereign, later on by the larger commercial banks. Now, I think it was November 21 that Uzbek issued its first som bond in the international capital markets, heavily oversubscribed. And we believe, going back to your question, so what is the ultimate success? So the ultimate success is that TCX as an institution becomes obsolete and local borrowers get access to international capital markets in their own currency. Because however superior the development of local capital markets is, for some countries, the economy is too small to provide the tenors and the depth needed for the development that is needed today. So I'd like to stay.
Yeah, thank you very much. I think it's very clear, and it's really the offshore. You're attracting interest of investors that we hope eventually will scale up their operations onshore. I would like to turn to Katarina now. The EU has been supporting our work in local currency operations all over our countries of operations for a long time. And really, my basic question is, why are you doing it? Why are you committed? Tell us, what do you want to achieve through this work?
Well, thank you for the question. Thank you for inviting me. I'm delighted to turn this into a non-panel and then to a panel, although I'm the only one. Why are we doing it? What's our objective? And we are not looking at it from developing capital markets. That we leave to our IFI friends. But what we do is, as part of our economic investment plans, want to invest in solid, resilient local economies of our partner countries. And the part of the Commission which I represent covers the countries around Europe, so Western Balkans, MENA region, and Eastern Europe. And in many, if not most of our partner countries, we've seen huge volatility in the currency markets and exchange rates over the last 15 years. And most of those were external shocks. So there is lack of resilience to external shocks. So we were looking at how to not contribute to the problem, but how to find local currency solutions. The one thing that we have figured out is that there is no silver bullet. There is no one solution that we should pursue for a variety of reasons that have been discussed. So what we have done is look at three different vehicles or three different routes through which we support local currency development. One, and very much going in line with what Ruth was saying, is the local issuance. So we've supported EBRD, can support others in the future who have revenues in local currency to issue local paper in local currency. That's one. That's the most optimal one, but there is not enough of it, or not in all markets. We have, as a second route, we have invested quite significant amounts of resources into actually developing a new share class in the KfW is our trustee in the structured funds like Sanad and GGF and FSED that invest across our regions. And so we created L shares that actually are specifically designed to cover the foreign exchange risk. And more recently, especially with our new product, which is a de-risking instrument called European Fund for Sustainable Development. It's a mouthful. It's a guarantee. We have been supporting TCX to make TCX price more affordable to local players, and we have done that in sub-Saharan Africa. We're also in the neighborhood, and we are going to support further the expansion or affordability rather of TCX, as the hedging solutions are for the small currencies often fairly costly. And so it's really to support the development of the local private sector.
Yeah, thank you very much, Katerina. I think here we are fully aligned. We are doing it not just for the sake of the beauty of local market, but really to reach ultimately clients and make sure that it's done safely. We also learned a lesson since 2008 that you need to have local markets development, local currency development in order to do it, let's say, safely or responsibly. And then the very last but not least, we have Jason from Citi, who you've worked in a range of countries, you cover this region. We wanted to hear from you briefly, what do you see as success from your perspective? You know, you work on infrastructure. You're actually one of the, in a way, infrastructure providers because you do custodian function in some of the markets. But also you work with actual investors or people who want to invest in the region. Tell us, how do you see success?
At Citi, we move based on our clients' needs. And our clients can be local clients, whether it's banks or governments locally. And then our global investors too. So we're on both sides of the coin, and we see an increased interest in local currency exposure by the international investors in this region, and as well by local banks, governments issuing local currency. De-dollarization is key for many of the countries in the region. As mentioned earlier, Citi had the pleasure to be on the government of Uzbekistan's local currency Eurobond issuances, both tranches over 2020 and 2021. But in order to move to the direct onshore markets, This would be taken in two different views from Citi. One where we have a local custodian presence, like in neighboring Kazakhstan. And then if we don't, we would have to partner up with some local custodians, of course. But it's not impossible. So the infrastructure is key. If we're talking about, so there's many different aspects you can look at this, right? Because there's the FX market, the interest rate market, the debt market, and also the local equity market eventually, perhaps, right? So infrastructure is key, but if we will look at, for example, derivative transactions, for a bank like Citi, we will, of course, first look at standardization of documentation. This is very key for us. Is the CSA strong opinions that are internationally recognized? This is, I would say, step one, right? But to increase international participation as well, you know, there needs to be many players in the market for there to be liquidity. Liquidity is key for any market, especially such developing markets. So these are the main points that we look at. Of course, if you're looking at sovereign bond markets, right, is such macroeconomic policy, and let's call it the investor relations aspect of that, right? So having international credit ratings, having regular publication of economic data, research data, which sometimes can be limited in the region, but is growing quite significantly, particularly over the past 2 years. So this can bring increased investor attention.
Jason, thank you. So you both highlighted this sort of global perspective on the market, and both the progress made so far by mentioning a few of these solutions that actually we see progress happening in infrastructure, in transparency, in legal certainty, but also you kind of outlined a bit of a horizon. For example, local investor base, it's the need in the longer term in order to deepen the market and focus on, let's say, more advanced longer-term products, equity markets. And so we will continue to work with this region as we work everywhere with our partners, including donors, European Commission, with all of the partners, with policymakers, with commercial banks. So it was very good to have this panel. We have actually run out of time, so I just want to thank everybody in the panel, the first and second panel, but also all the people in the audience who stayed till the very end, and those who watched us online. So I want to say thank you very much and see you next year.